Hey everyone, welcome back to Corporate Decoder, the place where we untangle SEC filings and make sense of what companies are actually saying to investors. And this filing for Grainger Incorporated gives us a pretty interesting look at their financial health heading into the end of 2025. We're diving into their quarterly report, also known as a 10Q, which gives us a snapshot of their performance for the 3 and 9 months ending the 30th of September 2025. Before we dive in, make sure you smash that subscribe button and ring the bell so you do not miss out on our future breakdowns. And hey, if you want to connect with like-minded folks who love dissecting company reports, join our Discord community linked in the description below. It is where we share insights and discuss all things corporate finance. So what is the big story here? The company is navigating a bit of a challenging economic landscape with global volatility and uncertainty. They are seeing increases in costs for things like commodities, labor, and transportation, and they are keeping a close eye on inflation and the risk of recessions. You know, that general economic stuff that affects businesses everywhere. But Grainger, which is essentially a big distributor of maintenance, repair, and operating products, has a diverse customer base, and their products are usually needed no matter what. So they have a bit of a built-in resilience. Let us jump straight into the numbers, because that is where the real story unfolds. Looking at the 3 months ending the 30th of September 2025, Grainger brought in $657 million in net sales. That is a 6.1% increase compared to the same time in 2024. That is a pretty solid jump. On a daily constant currency basis, which means we remove the impact of foreign exchange rates, and the number of selling days, they still saw a healthy 5% increase. This growth is coming from both their high-touch solutions, North America business, and their endless assortment segment, which tells us they are performing well across different strategies. Now, for the 9 months ending the 30th of September 2025, the story is similar with net sales hitting $517 million. That is up 4.5% from 2024. Again, a consistent growth trajectory. This growth across both segments shows a balanced performance, which is always a good sign. But what about the profit margins on the surface? Gross profit for the 3 months increased by 5% to $798 million. However, the gross profit margin actually dipped by 60 basis points to 38.6%. This is a key point. While they sold more, the cost of those goods sold increased at a faster rate, or they had to absorb some of the cost increases themselves. The company mentions this is due to a negative price-cost spread and inventory valuation methods like LIFO that can make margins look different depending on inventory costs. For the 9-month period, gross profit increased 3.6% to $5, $263 million, but the margin also decreased by 40 basis points. So it seems like despite selling more, their ability to keep a bigger chunk of that sales revenue as profit is slightly under pressure. Now let us look at their operating expenses, those selling general and administrative expenses, or SG&A. For the 3 months, it went up a significant 24.5% to $287 million. The company attributes this mainly to higher marketing expenses. That is a big jump, and it is eating into operating earnings. For the 9-month period, SG&A also climbed 10.5% to $402 million. Now, they do try to smooth this out by talking about adjusted SG&A expenses, which exclude some one-time items related to exiting the UK market. The adjusted figure for the quarter was $1,091 million, still up 6%, and this increase in expenses directly impacts their operating earnings. For the 3-month period, operating earnings dropped 25.5% to $511 million. Adjusted operating earnings were up a modest 3% though. For the 9-month period, operating earnings were down 7.1% to $1,861 million. Again, adjusted operating earnings saw a slight increase of 1.8%. This suggests that while the core business might be growing, the added expenses are putting a squeeze on profitability. And that brings us to net earnings for the 3 months. It came in at $294 million for Grainger Incorporated's shareholders. This is a pretty steep 39.5% drop compared to 2024. Even adjusted net earnings only saw a small 0.8% increase. This is a pretty significant decline and points to the impact of margin pressure and increased operating costs. For the 9-month period, net earnings attributable to shareholders were $255 million. That is down 12.5%. Adjusted net earnings were up just 0.3%. So while sales are growing, profits are clearly facing headwinds. Let's dig into the segments to see where this is happening. The High Touch Solutions North America segment saw net sales grow 3.4% to $3, $635 million for the quarter. Their gross profit was up 2.3%, but the margin dipped 50 basis points. SG&A expenses here also rose 3.1%. Ultimately, operating earnings for this segment were up a tiny 1.1%. So while sales are okay, the profitability is not really moving the needle. Now the endless assortment segment, which includes businesses like Zoro and Monetaro, showed much stronger performance. Net sales jumped a solid 18.2% to $935 million for the quarter. Their gross profit grew by a healthy 20.6%, and the gross profit margin actually improved by 60 basis points. SG&A expenses did rise by 22.1%, but operating earnings still managed a good 17.1% increase. This segment is clearly the growth engine and a bright spot in the report. Interestingly, Grainger is planning to sell its Cromwell business in the United Kingdom. This is part of their other businesses which are not considered reportable segments. As of the 30th of September, they had $50 million in assets held for sale and $82 million in liabilities held for sale. They recorded an asset impairment loss of $186 million because of this decision, which is a pretty big hit to their SG&A expenses for the quarter. This move is part of a larger intention to exit the UK market to focus efforts where they see the greatest long-term impact. They also are proposing the closure of Zoro UK. Let us look at the balance sheet and debt. Total debt as a percentage of total capitalization was 37.4% as of the 30th of September 2025, down from 42.9% at the end of 2024. This indicates they are managing their debt levels well. They have a good credit rating from Moody's and S&P. However, there is something interesting here regarding their debt. Between 2015 and 2024, they issued around $2.8 billion in senior notes, and then in February 2025, they repaid $500 million of those notes all at once. This contributed to a significant increase in cash used in financing activities for the first 9 months of 2025, which was $599 million compared to $615 million in 2024. Despite the cost pressures and a desire to become more efficient, Grainger is still investing in its infrastructure. Property, buildings, and equipment net increased to $237 million at the end of September 2025, up from $927 million at the end of 2024. They are spending money on capital expenditures, particularly on supply chain investments in the US and for Monetaro. This shows a commitment to long-term growth and efficiency. Cash and cash equivalents were $535 million at the end of September 2025, down from $036 million at the end of 2024. This decrease is largely tied to that debt repayment and the increased capital expenditures. However, they still had about $1.8 billion in available liquidity, which is a good buffer. Looking at leadership and insider transactions, D.G. Macpherson, the CEO, adopted a written plan for exercising options and selling shares in September 2025. This plan is designed to comply with securities regulations and will be in effect for about a year. Also, in a significant move for executive compensation, Grainger approved new severance and change in control severance plans that will go into effect at the end of 2025. These plans will offer enhanced benefits to senior executives, including a multiple of base salary and target bonus plus equity acceleration upon certain termination events, or after a change in control for the company. This is pretty standard for executive retention and incentive, especially for top leadership. So what does it all mean for Grainger? On one hand, they are growing sales, especially in their key segments, and they are making strategic investments in their infrastructure, which is good for the future. Their endless assortment segment is clearly performing very well and is a major driver of growth. They are also managing their debt effectively and have strong credit ratings. However, on the flip side, their profitability is under pressure. Gross margins are shrinking, and operating expenses are rising faster than revenue in some areas, which is really eating into their bottom line. The decline in net earnings this quarter is a stark reminder of these challenges. Their decision to exit the UK market and incur significant impairment charges also highlights potential past strategic missteps, or at least a need to refocus their global strategy. In conclusion, Grainger is a solid company with a strong core business in North America and a growing international presence through its endless assortment segment. They are making the right moves to invest for the future, but they need to find a way to translate that revenue growth into better profit margins. The next few quarters will be key to seeing if they can manage costs effectively and navigate these economic uncertainties while continuing to grow the business. Alright, that is our breakdown of WW Grainger Incorporated's latest quarterly report. What are your thoughts on these numbers, especially the margin pressure and the UK exit? Let us know in the comments below if you found this analysis helpful. Please give this video a thumbs up and subscribe for more deep dives into corporate finance. And do not forget to join our Discord community through the link in the description to keep the conversation going. Thanks for watching, and we will see you in the next one.